Throughout the United States, a massive surge of job cuts is underway. Challenger, Gray, and Christmas published a report indicating that in November, American companies accelerated their employee layoff rates by 127% compared to the prior month. Companies announced 76,835 layoffs in November, representing a 417% growth from the same month the previous year. Ordinarily, firms employ more individuals during the holiday season to accommodate heightened consumer demand. Nonetheless, this year's circumstances are markedly distinct, as U.S. citizens grapple with increasing costs for essential items and diminished disposable income for presents. Additional companies, such as Pepsi, Best Buy, and FedEx, are struggling with escalating operating expenses and insufficient revenue, while others like Sears and Kmart experience plummeting sales and serious financial repercussions. As the ongoing economic turmoil intensifies, businesses must confront difficult choices, with many of those choices involving employee layoffs. In preparation for harsher conditions, we have assembled a list of 10 major retailers that have disclosed job cuts. Walmart. As Reuters discloses, Walmart is terminating approximately 1,500 employees at its Atlanta fulfillment center while transitioning operations to more lucrative markets, pursuant to the August announcement of the company slashing numerous corporate positions to enhance clarity and strategically place the company for a robust future. Predictably, consumer expenditure dropped significantly in Q4, particularly in non-essential sectors like apparel. In this year's Q2, Walmart's earnings suffered greatly due to an overstocking debacle leading to a sharp decline in inventory value. The retail giant also witnessed the most severe single-day stock market loss since 1987's Black Monday, and its sales projection for this year's festive season is roughly 6% beneath investors' anticipations. H&M. To reduce costs, H&M, the world's second-largest fashion retailer, is presently dismissing 10% of its workforce, which equates to over 1,550 employees, in response to slow sales and a worsening cost of living issue impacting consumer spending. H&M indicated that the reductions will save the company almost $190 million by September 2023. The company also underscored the difficult circumstances it faces, with customers in key markets reducing non-essential spending due to increasing food prices and escalating everyday expenses. Earlier, the clothing retailer reported a 30% decline in profits for the 9 months ending in August. H&M expects to reveal further restrictions on sales and earnings next month, as in-store visits have diminished by an average of 36% compared to the same time frame in 2021. In September, H&M disclosed that sales were persistently weak in most regions, both in the US and Europe. DoorDash, a retail and food distribution platform, announced last week its plan to let go of 1,250 workers starting this month. The company attributed the layoffs to an increased delivery demand in 2020, admitting to overhiring employees during that period. This harsh reality eventually led me to make this tough choice to decrease our staff numbers, CEO Tony Zhu remarked, mentioning the layoffs despite DoorDash's exceptional financial performance. While revenues have grown in recent years, profits tell a different tale. Zhu also noted that expenses had surged, resulting in a $296 million loss in 2022, nearly triple the $101 million loss experienced in the same time frame in 2018. Presently, the company incurs a loss of nearly 70 cents per order, a significant jump from the 41 cents it was losing at the start of the fiscal year, as per Neil Saunders, managing director of Global Data. Furthermore, the firm's stock value has dropped almost 60% year-to-date. Rent the Runway. In September, news surfaced that Rent the Runway intended to dismiss nearly 25% of its workforce by 2022's end, following a 20% drop in subscription demand during the second quarter. Based on the latest financial report, more layoffs could be looming as the company's net losses reached $33.9 million in the first quarter. These reductions entail closing various roles, minimizing backfills, reorganizing specific functions, and reallocating resources. Nordstrom. The retail department store Nordstrom recently announced the impending permanent closure of an Iowa fulfillment center, which had employed over 1,100 individuals, resulting in the loss of 231 jobs. With consumer demand and traffic rapidly decreasing, Nordstrom is now reallocating the center's product volumes to areas with higher sales. A company spokesperson declared in a statement, "We have made the difficult decision to reduce our workforce and our Midwest fulfillment center to better align with the current needs of our business." The retailer has observed a slowdown in this market since August, and according to an October study by Comparably.com, at least 10% of Nordstrom employees reported accepting a pay cut to maintain their employment. StockX's CEO, Scott Cutler, announced the third round of layoffs for the apparel and footwear resale marketplace this year as a cost reduction measure focusing on existing investments. To ensure long-term sustainability, the company reduced its workforce by 12% in April, curtailed discretionary spending, limited new hiring, and enhanced trade process efficiency. At that time, fewer than 150 employees were affected, as per the company's report. In June, the workforce increased by 8%. The recent layoffs impacted 80 team members, but as stated in an insider stock exit report, there had already been 2 rounds of layoffs prior to this month's third round. In a message to employees, Shopify CEO Toby Lütke revealed that the company would lay off nearly 1,000 of its 10,000 workers, which is 10% of its workforce. Lütke conceded he had miscalculated the duration of the e-commerce surge driven by the pandemic and the subsequent overall decrease in online expenditures. Consequently, the firm had to cut various roles to maintain profitability. The majority of impacted positions were in recruitment, support, and sales, instead of specialized and redundant roles, as well as certain teams that were nice to have but too distant from the core business. Lütke now acknowledges that the gamble on perpetual high growth did not succeed, as Shopify and other e-commerce sector companies could not maintain the rapid expansion they previously experienced. Best Buy has started eliminating hundreds of roles in its stores nationwide due to a slump in electronic sales. The company disclosed this shortly after reducing its sales and profit projections for the current quarter because of diminished consumer demand. Best Buy had already anticipated lower sales at the end of the previous quarter. However, in a statement, CEO Corey Berry remarked that the slowdown is occurring quicker than anticipated due to fluctuations in the macroeconomic landscape and an increased shift towards digital shopping. A company spokesperson informed the Wall Street Journal that consumer demand in the electronics sector has further weakened as inflation rises and consumer sentiment continues to decline. Best Buy expects sales to drop by around 13% for the current quarter and by 11% for the full year. The company laid off almost 5,000 full-time employees in 2021. Starting in 2022, the corporation had about 105,000 workers, a decrease from nearly 125,000 at the beginning of 2022. FedEx. As we approach the year's busiest shipping period, FedEx Freight announced in November that it would start enacting furloughs across multiple U.S. areas. The decision was influenced by the ongoing business environment's impact on volume. The peak season has been underwhelming so far this year, and it will only accelerate the capacity adjustment already underway. The statement highlighted that other carriers, such as Werner, J.B. Hunt, Knight, and Swift, are also adapting to economic instability and expected reduced holiday demand. To align with the less-than-anticipated demand, FedEx has initiated the furloughing of 3,500 employees just before Christmas. A company representative stated that the furloughs would last about 3 months, during which affected staff will retain health benefits and can seek unemployment benefits from the state. PepsiCo. To stabilize its finances, a prominent American food retailer is also laying off numerous employees. Over the past year, PepsiCo has raised prices to compensate for increased costs related to ingredients, transportation, and labor. These job cuts will affect the company's beverage, snack, and packaged food divisions. The production of well-liked snacks such as Doritos, LAYs, and Quaker Oats did not disclose the exact number of roles impacted. We value your time spent watching this video and encourage your feedback in the comments section below.